Assalamu alaikum friends, welcome to day 3 of AFM Division Crash Course. Today's topic is International Investment Appraisal. Previously in day 2 we covered investment appraisal where we calculated net present value, we went through IRR, MIRR, all those methods. In international investment appraisal we are going to cover more complex issues such as exchange rate risk, MNCs, all those stuff, right? So let's go to the topics that we are going to cover here. The topics that we are going to cover today are: first, we are going to go to the past exam. Multinational companies, international trade, trade agreements, international financial institutions, the global credit crunch and toxic asset, strategic issues for MNCs, focusing foreign exchange rates because this is international investment appraisal. So we need to focus the foreign exchange rate. Foreign projects and investment appraisal. So let's go to the past exam history. If you see, earlier we calculated net present value for our domestic projects. Here we have to calculate foreign net present value. Same way we are calculating. The calculation of net present value will not change. Whether it is local or whether it is international. That will remain same. The only thing is now you have to predict exchange rates to convert those foreign currency to your home currency. So that the net present that you are calculating is in your home currency. Okay. And foreign net present value has been asked 4 times. And thrice it has been asked as a question number 1. That means as a 50 marks question. That shows that this topic is very, very important. Okay. So when you're studying net present value under your investment appraisal, make sure that you learn the international net present value as well. Then we are moving towards the discussion of risk associated with the foreign expansion. This also was asked as it was in the same question that the foreign net present value was asked. That's why, as you can see, it's in question number 1 in the same year. International financial institution. This was asked as a 50 marks question again in September 2017 once. And discussion of transfer prices has been asked 3 times. Okay. And securitization has been asked once. But the most important out of all this is your net present value. Okay. One is net present value, the other one is the risk of foreign expansion. These are the 2 areas that examiner could ask in your question number 1. Mostly it is asking question number 1, foreign net present value. Okay. Because the thing is there are so much work is there. First of all, you have to calculate the net present value, then you have to use the foreign exchange rate and convert it, and then you have to talk about the risk, and also this all these requirements cannot be asked in a 25 marks question, right? It's asked in 50 marks question with the 4 professional marks in section A. So now let us go to our first topic, that is multinational companies. What is multinational companies? Multinational companies is any company who generates at least 25% or more of its sales are from other countries. Okay, foreign countries, that is known as MNCs. Then MNCs are largely unregulated. Okay, but still there will be some national governance regulations that can affect their behavior. Okay, coming to international trade. Why do we go for trade? The reasons for overseas trade. Remember, whenever you are given an international net present value, where you have to calculate the net present value for a foreign subsidiary, you might also have to give, other than calculations, you have to write your theory part. So that theory part can be asked from here. For example, why the company wants to go for overseas trade? What are the risks of the international trade? You need to know all these answers. So what are the reasons? Let's go through some of the reasons why we do overseas trade. Number 1, choice. You might want to go for overseas trade, it's your choice. Second, competition. Competition is so huge in your local market that you have to go to overseas trade. Okay, because you cannot compete locally, there are so many competitors. So it minimizes your profit margin. So you want to maximize your profit margin by expanding abroad. Now, economies of scale, it will give you economies of scale because you can produce to a larger customer. Hence, you reduce your cost. So you achieve economies of scale. Specialization. Let's say you are very specialized in a certain commodity, making of a certain commodity. So if you sell it outside, you'll be getting a larger customer there. And hence you can minimize your cost as well. Because when someone is specialized, their cost will be low. The average cost will reduce. rather than someone who is not so specialized. He will be incurring more cost. So it's better to take some from someone who is specialized so that it reduces your cost. Maybe in the overseas, they are specialized in that sector, that business. So if you do business with them in the overseas, it will minimize your cost. Then countries can also seek to restrict imports. Okay, they might want to reduce import. They might want to restrict the level of import that is happening. They are known as trade barriers. What are the trade barriers? It can include quotas. It can include tariffs. Right? They will give a percentage. Okay, that this is the percentage. Beyond this, you cannot import. Then we have exchange controls. Okay, exchange controls we are going to study in more detail later on. Administrative control can be put into place. Okay, and embargoes. Now we are moving towards the trade agreements and international financial institutions. You don't have to know this in detail. Okay, very briefly only you have to know, because usually they don't ask for so many marks. So what are the trade agreements? These policies are adopted by governments to encourage free trade. Governments want to promote free trade, that everyone trades with each other. So in order for that to happen, there are some trade agreements that are in place. Okay, if you see in your textbook of AFM, this section is from your section A of your syllabus, role of financial advisor. Okay, bilateral trade agreement. Okay, then we have multilateral trade agreement. You must have heard about NAFTA, North American Free Trade Agreement. Then we have SAFTA, NAFTA, WTO, World Trade Organization, right? Then we have free trade areas. Custom Union, economic communities, economic union, Eurozone. Out of this, mostly which is asked is Eurozone, that is your EU. Okay, what are the advantages of working within EU? What are the advantages of working outside the EU? What could be the advantages for the member countries? What could be the disadvantages for non-member countries? This type of questions they ask usually. Okay, other areas you don't have to know much, because usually because the all of them, their main goal is to encourage free trade. Okay, so if you study one Eurozone, that's enough. You don't have to study in detail about all those things. Even though it's there in your textbook, just for understanding, you don't have to go through it in depth. It's not required. If you know advantages and disadvantages of EU, that's enough. Coming to the international financial institutions, some very important. Number one, IMF. Then we have IBRD, that is the International Bank for Reconstruction and Development. Now it is known as World Bank. The name is changed to World Bank. World Trade Organization, the Bank for International Settlements. Right? So these are some few international financial institutions. You must know their role in helping trade, international trade and all. How do they encourage? You must know that aspect of it. Other than that, in depth, you don't have to know when it was created, when it was started, what are the changes they are making. All those things are not required. Okay. Then we are moving towards the most important, the hot topic of in today, that is the credit crunch and the toxic asset. What is this credit crunch and toxic asset? Over the few years, you have heard about this credit crunch, right? In the media and all, credit crunch, credit crunch. What is the exact meaning of credit crunch? Okay, so the credit crunch is, the phrase is used as toxic asset. Okay, this toxic asset, that means this asset is not good. It's toxic for you if you have it too much, right? So the toxic asset has been used by the international media to describe the range of financial products traded by banks. So these are some financial products, this toxic asset that are traded by the banks in order to what? Earn income and lay off risk. But there are huge risk in this. That's why it is toxic asset. It is not a good asset. There are some asset which is good for you and some which is toxic. This is that toxic asset. And because of this, credit crunch took place. In 2008-9, we know what happened, right? So make sure that you are up to date with the latest current issues and all in the finance world. read newspapers, read journals. On your Facebook, you can see, right? Because a question can be asked from this area also, the current issues relating to the finance world. For example, credit crunch is one, securitization, then what are the other things? I exactly don't remember, but just make sure that you go through this current issues and all. Next, we are moving towards the so because of these consequences of credit crunch, what happened? Bank was not reluctant to lend anymore to the business. Therefore, the business suffered overall. Worldwide, all the businesses suffered. Customers' purchasing power reduced. They were not able to buy. They were saving. Okay, and also business struggled to get debt to refinance their debt. They were not able to pay back their debt because so much of this toxic asset has been given by the bank. They have traded with this toxic asset. Next, we are moving to the strategic issues for multinational organizations. For your exams point of view, this part is very important. All this while, whatever we were covering, you just have to know briefly, that's it. But this you have to know in depth because you have to write about it. Especially in your section A, if a question is asked on international net present value, where you're supposed to calculate net present value when it's an international when you are trading with international organization. So strategic issues means the risk, okay, of operating with it and the benefit also, both. So what are the implications of increased mobility of the capital? That means your capital is very free to move now. What are the implications? Number one, it lowers your cost of capital because capital can move freely among the countries. It reduces your cost of capital, your WACC. Then, ability to switch between countries and to avoid national restrictions. There are no national restrictions. If you are having some restrictions in your country, you can avoid it by switching it to some other country where such restrictions are not there. Then you have the increased exposure to foreign currency risk. There's a drawback to it. You are exposed to foreign currency risk. Now, transfer pricing. Very important. This aspect is very important. Transfer pricing. You might sometimes have to calculate also, and sometimes might have to. There are I think 4 or 5 methods of calculating transfer pricing. You will get it in your textbook. So go through this 4 and 5 methods of calculating transfer pricing. But in this video, I'm not going to cover that. My focus is what are the issues. So number one, transfer pricing. The problem with the transfer pricing is that you can use this to switch profits into the lower tax countries. It often happens, right? In the parent and the subsidiary are in different countries. The country where the taxes are lower, profit are transferred to that country. Why? Because then you have to pay low tax. You reduce your tax by that. But remember, tax authorities will investigate. Are you setting your prices too high or too low? They will investigate these things. So this is an issue for the multinational companies, transfer pricing. It is not there when you're doing your business locally, but for multinational companies, yes. Next, we have economic risk. Economic risk is there. What is economic risk? Economic risk will be reduced if a company operates in several different economies because you are less reliant on one currency. Let's say your currency, the value goes up or down, it changes, right? If it goes in your favor, it's good. But if it goes against you, at least you're not dependent on that unfavorable situation. You can minimize that risk by relying on other currencies. So economic risk is reduced. Then we are moving towards political risk. Political risk is when the government brings out some new laws or regulations and it affects your business. So MNCs are exposed to that. One is confiscation political risk. Then we have commercial political risk and we have financial political risk. You don't have to know this detail. You don't have to explain it also. These are just some examples of political risk. Then we have exchange control risk. This risk is very important for AFM's perspective compared to other types of risk. Okay. What is exchange control risk? Exchange control risk means the government is controlling the amount of currency that you are remitting to your home country. For example, you have earned surplus fund in a foreign country, and now you want to remit that back to your country. You cannot remit the full amount. There is some limit to that. So government will use this exchange control to limit that remittance. Okay, so surplus funds can accumulate in a subsidiary country which cannot be remitted out. You cannot remit out. Maybe you cannot remit out at all. Maybe a certain percentage only you can remit and certain you cannot. So this is the way they are putting a control over their remittance. But this can be mitigated using forex hedging. We'll see hedging and all later. But through hedging and all, you can minimize this risk. Okay. Then we have goal incongruence. What is it? This is an issue, right? It's a problem. Issue means problem. That means MNCs will have a separate interest and the organization will have a separate interest. So their goals are not in line with each other. MNCs divisional managers will place their own interests above the organization. So that's an issue. Then now we are moving towards the forecasting foreign exchange rate. Very important. Exchange rate is very important in international net present value. Okay, so you have to link your risk management, your foreign exchange risk with the investment appraisal. But we are not going to cover the whole thing of risk management. Okay, you only have to know these two things. That's it. How to predict the exchange rates using two things. One is interest rate, the other one is inflation rate. So in a question, if you are given, you will be given some inflation of two countries, or you might be given the interest rates of two countries. You should know which one to use to calculate foreign exchange rate, right? So, and both of this will be given to you. Okay, for example, in a question, if you are given the two interest rates of two countries, that means you have to use interest rate parity. It is known as interest rate parity, IRP. If you are given the inflation of the two countries, you have to use purchasing power parity. I can see on the screen the P is missing out. Okay, so that's purchasing power parity, the triple P. This also will be given to you in the question. The formula I have given below for both, and the formula is there in your formula sheet also. Okay, for both, remember the current spot price will be given to you in the question. Okay, that is S0. That will be given to you in the question whether you have to use interest rate parity or purchasing power parity. It will be given to you. So using that, you have to multiply it by the fraction. What is the fraction? 1 plus IC divided by 1 plus IB for interest rate parity. IC means interest rate of the counter country. IB means interest rate of the base country. Okay, counter currency is your foreign currency and base currency is your home currency. Same for the inflation also. Inflation of the counter currency divided by inflation of the base currency. Okay. So this is how you have to predict your exchange rate. Why you have to calculate the exchange rate? For example, when you're calculating net present value, your cash flows, right? Before discounting, you are making, let's say the project is for 5 years. So for all the 5 years, you don't know what is the exchange rate. You are only given the current spot rate, that is at year 0. So using that rate, you have to predict the exchange rates for all the 5 years. How are you going to do that? Using these formulas. Either this, either that. Depends on what is given in the case study. If it is interest rate, then interest rate. If it is inflation, then it is PPP. But the formula remains the same, okay? And also check which, if you are using interest rate or inflation, you have to see which one is going to the top and which one is coming to the bottom. That matters a lot. You cannot use it anyway. Okay? So using that, you will convert your foreign net present value to your home net present. For example, not the net present value, if you are calculating the cash flows for the 5 years, all the cash flows for the 5 years, that is calculated in the foreign currency. Now you are going to convert it into your home currency using this exchange rates that you have predicted for the 5 years. Now we are moving towards the foreign projects and investment appraisal. So this is a diagram. If you follow this diagram, you can never go wrong in the international net present value. That is, number one, net present value analysis on foreign projects. How do you do this? There are certain steps to do, certain ways to do. There are two methods of doing it when it's international net present value to calculate. Step number one is common for both. Okay, the two methods. Step 1, estimate the project's cash flow post tax in the overseas currency. Whatever the cash flow is there, after deducting tax, calculate in the foreign currency, overseas currency only. Step number 1, whichever method you are using. Step number 2, there are two methods. Okay, if you are using method 1, you convert the flow to the home currency, cash flow to the home currency. Okay, it's not flow, it's the cash flow. That cash was missing, so convert the cash flow to the home currency. That means whatever the foreign currency, you convert to the home currency. Second method is, this is also step 2, is step 2. Okay, one of these two methods you have to use in your exam. Convert the company's cost of capital, that means your company's cost of capital, you convert to an overseas equivalent, assuming IRRP or PBP, anything. So you're not converting the cash flows, you are just converting one figure, that is cost of capital, because the cost of capital is in your home currency, sorry, home country, right? That you need to convert into foreign currency. So the overseas currency will be in the overseas currency only. Only the cost of capital that you need to discount the cash flows, you are converting that only. So that one cost of capital you are converting. For example, if the cost of capital is given 10%, but that is for your home currency. What about in foreign currency? What is the cost of capital? You have to find it out using same IRPP or PPP. Then you use that cost of capital and convert it and find the net present value in the foreign currency. Step 2 is not like that. Step 2, for each of the years, you are converting the overseas currency to the home currency using the exchange rates that you have predicted. And mostly we follow the first method. First method means on your left side, the step 2 on your left side, convert the cash flow to the home currency. We follow that method. In the exam also, if you have seen, we convert for every year. Next, step 3. So step 3, if you are doing on the left side, add any home country cash flows, example tax, because you are converting the cash flow to the home currency. After you convert, whatever the home country cash flows are there, you can add it. For example, tax that you have paid in your home country, in your currency, that you can add. But what if is the second method? Second method, I mean on the right side. Okay, whenever I say first method, you have to refer on the left side, and whenever I say second method, you have to refer on your right side of your screen, because both are step 3, so you don't get confused. So if it is the second method, use adjusted COC, cost of capital, to find net present value in overseas currency. So whatever that cost of capital you have found out, adjusted, that you use to find the net present value in the overseas currency. You're not finding in your home currency, you're finding in the overseas currency, the net present value. Step 4. So step 4, if it is the first method, you discount the net home country cash flows at the company's cost of capital. Whatever the cost of capital you have now, you can convert it. So now you can discount using that only. Why? Because you have already converted the foreign currency into your home currency. So currency is also in your home currency. Cost of capital is also in your home currency. You can use that to discount. And usually most of the time we follow this method only. Step 1. Sorry, method 1, where we convert each years of foreign currency to your home currency. Then we discount it using our cost of capital. So cost of capital we are not changing. That cost of capital only we are using to discount. In the exam also you see that this is the pattern that we have been doing. But what if we are using the second method? Then because the cash flows are in overseas currency, net present value also we are finding in overseas currency. So you convert the net present value into the home currency equivalent. That means you find the net present value in the foreign currency, and that one figure only you are converting to home currency. But I have not seen any question in AFM till now which is using the second method. But you should know both the methods, okay? Then step 5. Step 5, finally you are getting the net present value, and net present value will be same. Does not matter what method you are using. Under both the method, net present value you are getting same. Okay, but there is an additional step, that is step 5 if you are using the second method. That is, add the present value of an additional home country flows, example tax. Okay, for example, if there's any present value of an additional home country flows and all, example tax that you have to add, because earlier you didn't take it. Why? Because earlier you took it in foreign currency only. So whatever the cash flows of the home country, for example tax, you didn't take it in the picture. You use the foreign currency cash flows, converted using the cost of capital, and found the foreign net present value. That foreign net present value only you converted to home currency. So with that you have to add whatever the additional tax that you had to pay in the home country. Okay, foreign projects and investment appraisal. Now we are moving towards the net present value, the appraisal part. So the appraisal part is done in the same way as the domestic net present value. But following things you have to take into consideration when it is international net present value. What are they? Number one, taxation. Tax. Question will always assume a double taxation treaty. Always. Therefore, the project's profit gets taxed at whatever is the highest rate between the two countries. Then we have intercompany cash flows. In the exam, assume that such cash flows are allowable for tax and state it. Unless the question says otherwise, you have to state it that you are assuming that this is allowable for tax. Next, if an intercompany cash flow is allowable for tax relief in one country, then there will be corresponding tax liability in the other. Remember this. This is a key point. Tax relief in one country, tax liability in the other for the same cash flow. Okay. Then, assuming that the tax authorities will only allow arm's length, that means open market prices only for the tax relief. Okay, they will not allow tax relief for anything. For example, if you are artificially charging very high price, for that you will not get tax relief. It is only for the normal price, the open market prices only. Then we are moving towards remittance restrictions. Remember, we told that we are going to put exchange control to reduce or limit the remittance that you are going to pay back to your country. So this is the additional consideration that you have to think about when it is international net present value. This things is not important for your local net present value where you are doing business locally. So remittance restrictions. Overseas government, they might place limit on the fund that you can send back to your company, holding company. For example, the subsidiary, they cannot sell the fund back to the parent because the government has put limit. It is the parent company's cash flow that should be converted into the parent's currency terms and discounted to net present value. Okay. So after remitting also, if they are remitting anything, because it is from the foreign company, okay, still when you are remitting it, it will be discounted using the parent company's cost of capital. Okay. Then we have working capital. So working capital, you have to assume, unless told otherwise, that the working capital for the overseas project will increase by the annual rate of inflation in that country. This is only for the overseas, okay? Overseas project. If it was not overseas project, then they will tell you that working capital will increase by this percentage of sales, increase in sales revenue and something like that. But when it's overseas project, that change in working capital will be annual rate of inflation. You increase it by the rate of inflation in that country, whatever country it is. In whatever country, the currency that you are finding the net present value, for example, if it is in dollar that you're finding and the working capital you are calculating in dollar, so whatever the currency rate in US, currency rate of that inflation, you have to use it. Next, we are over with international investment appraisal. Now let us go to the exam focus. What do you need to focus on? Use the simpler 4-step method in an exam unless told otherwise. So whatever the steps that I have followed, the diagram you need to follow. Okay, you don't have to write it in the exam, but when you're calculating, follow that. That you will first find the net present value in the foreign currency, not the net present value, the present cash flows. Then you will find the exchange rate. Then you will discount. Okay, you will convert and then you will discount using the home countries. cost of capital, and you will finally find the net present value in your home currency. That is method 2. Okay, and you can do the method 2 if the question asks you to. Okay, next, further reading. So these are some areas that you need to read. There are 2 articles on your ACCA website that covers this international project appraisal in detail, so make sure that you read these 2 uh, technical articles. Okay, that will give you a better exposure to this, because this question has come many times, 3 or 4 times, as a 50 marks question. So I would suggest that don't miss anything on the spot. Even the technical articles you have to read. Okay, so that's it. Tomorrow's will be covering the financing decision. In the financing decision, this is a big chapter. We are going to cover things like WACC, calculation of WACC, asset beta, equity beta, debt, your bonds, all those things we are going to cover, so don't miss out. Till then, take care and see you till the next time.